Bismillahirrahmanirrahim. Subject is financial management, and today is the fifth lecture on valuation of long-term securities. Today we will discuss bond yield price relationship. What is the relationship between price of bond and its rate of return, that is called yield. Then what is the role of bond yield relationship? Rising rates, when there is increasing in interest rate, what will be happen to this relationship? Bond price relationship, when there is a decline rate in required rate of return or interest rate. So then we will discuss what is the role of bond maturity, what is the role of coupon rate in price yield relationship, and yield of preferred and common stock. That is the last topic of this long-term securities valuations topic. So bond price relationship. First we will discuss three bond prices of bond. Bond will be sold at discount when the market required rate of return exceeds coupon rate. So when market required rate of return is means which is called KD is greater than coupon rate, the rate which is written on the face on the bond, which do not change over the time of the life of the bond. So when your required rate of return is greater than your coupon rate, the bond will be sold at discounted price. Again, when required rate of return is greater than coupon rate that is stated on the face of the bond will be sold at discounted price. So par value will be greater than the market value of the bond. Par value or face value will be greater than the market value. So market will discount it for their required rate of return, the bond. Face value will be greater than market value of the bond. Premium bond will be sold at premium when coupon rate is more than the market rate. When coupon rate is more than required rate of return of investor. So the coupon rate exceeds the market rate of return, the bond will be sold at premium. So the market value at that time will be greater than, people will be willing to more, means in the market, to pay this bond than the face value of the bond. Third is bond will be sold at their face value at par when both rate, coupon rate is equal to KD. KD means required rate of return of the investor. So these are three, first of all, three relationship. If required rate of return is higher than coupon rate, bond will be sold at discount. If required rate of return is less than the coupon rate, then bond will be sold at premium. When coupon rate and required rate of return are equal, then bond will be sold and purchased at the open market at face value. Price bond relationship. This horizontal axis shows bond prices 600, 1000, which is called par, and 1200, 1400, and 1600. This vertical show the bond prices, this horizontal show the coupon rate, 2%, 4%. Coupon rate, that is interest rate. This is interest rate, this is interest rate in open market, this is interest rate in open market, this is interest rate in open market. Here the coupon rate and interest rate are equal. 12% is market rate, this is market rate, this is market rate, or required rate of return. Mean investor, when the open market provides the investor return, and we will discuss the range of these interest rate on bond prices. So 15-year bond, when this coupon rate and market rate of return, first of all start from here. If market rate of return, market required rate of return is less than coupon rate, bond prices will be higher. That is equal to somewhere 1300. If required rate of return is 4%, bond prices will start declining. When required rate of return become 6%, bond prices will be further decline. When required rate of return is 8%, then bond prices will be further decline. When required rate of return becomes equal to the coupon rate, the bond prices will equal to face value. Similarly, when required rate of return for in the market, then the bond prices will decline in the same way. For 18% will be the lowest one price. Now we will discuss it later, but for the 15-year bond we will see the same pattern. For 2% market price is higher, for 4% market price is higher. When the interest to market required rate of return increases, the bond prices decline. And so there is inverse relationship between the market rate of required rate of return and bond prices. But market price in open market, the bond price will be equal to face value, where coupon rate and market rate required rate of return becomes equal. Again, this is a point where coupon rate and market required return market required rate of return becomes equal. At this point, the bond price will be equal to its face value or at par value. Moving further, bond price yield relationship. When interest rate rises, then market required rate of return rises and bond prices fall. Interest rate means in open economy, when the interest rate, since bond are already have been issued by the company, so its coupon rate do not change with interest rate. It is stated amount of coupon rate which the bondholder will receive till the maturity of the bond. Now, when in open economy the bond interest rate rises, then the market required rate of return for individual is also rises, because when bank provides you, let's suppose 12% on your deposit, let's suppose on certain certificates or certain deposit, and in open market there is a bond which provide you 10%, so the people will not buy these bond. Let's suppose you invested 1000 rupees in bank who provide you 12% on certain on deposited this 1000 rupees. So the people will prefer to deposit their money in a bank rather than invest it in a bond, because it provides you 10% coupon rate. So they will buy the bond but at lower prices. Assume that required rate of return is 15%. Required rate of return on 15-year is 10% coupon. Annual coupon paying bond rises from 10 to 12%. What happens to the bond prices? It is like this. You have a bond in your hand and it has already been issued by the company. Let's suppose XYZ company. This is a bond of XYZ Limited, and you are holding it. So its maturity is still 15 years and it's give you 10% annual coupon rate. Now in open market, the interest rises from 10% to 12%. What will happen to the bond price? The bond price will decrease because in open market the interest rate increase from 10 to 12%. So the people will not buying your bond that you hold, but they will invest somewhere else in the market. So your bond prices will decreases. Let me explain it here. Bond prices required rate of return increases from 10 to 12%. What will happen to the bond prices of 15-year bonds? First of all, it was, let's suppose, on 10 1000s. Now it will be decreases somewhere to 900 or 800. This one. So the bond prices will be decreases. Interest rate increases, again bond prices decreases from 1000 to, let's suppose, 9, somewhere between 800 and 900. Now bond prices yield relationship rising rate. The required rate of return on 15-year bond, 10% annual coupon paying bond has risen from 10 to 12%. What will happen to the bond prices as we discussed earlier? Therefore, the bond prices has fallen from 1000 to 864,000. How we can calculate it? We can calculate it through discounted rate of return, as we discuss in an earlier lecture, as a valuation. This amount can be calculated as a on the calculator and time value of money tables. So, but the bond prices will fall when the interest rate increases from 10 to 12%. The bond prices will fall. There is inverse relationship. Declining rate. When the bond, let's suppose, when interest rate fall, then the market required rate of return fall and bond prices will rise. Interest rate fall, there is inverse relationship, so bond prices will be increases. Assume that required rate of return on 15-year bond, 10% annual coupon paying, fall from 10 to 8%. What will happen to the price? Again, in declining rate, that is bond prices. These are on horizontal axis, these are market required rate of return starting from 2% to 18%. This is 15-year bond. What will happen to it? Let's see. When market rate of return fall, prices of 15 years bond will increases. Market required rate of return fall, prices of 15-year bond will increases. There is inverse relationship. The role of bond maturity. The longer the bond maturity longer, the greater the changes in bond prices for a given change in the market required rate of return. It means for 15, if market prices increases from 10 to 12%, this rate will increase. Let's suppose if required rate of return increases from 10 to 12%, 15 years maturity bond will respond more. This will respond more to this change. It is more sensitive than the 5-year bond. So the longer the maturity, greater the changes in bond prices for a given change in the market required rate of return. Assume that for the same, we will discuss it in with the help of a graph. Assume that required rate of return on both 5 and 15 years bond, 10% annual coupon paying bond fall from 10 to 8%. Both bond have same coupon interest rate, same fall in required rate of return, but there is only difference in their maturity, 5-year and 15 year. 5-year and 15 years. These are bond prices and these are market required rate of return. And there are two type of bond. One is 5 years maturity and other is 15-year maturity. So what will happen for the same rate? Now let me explain. Bond prices, market required rate of return decreases from 10 to 8%. What will happen to the bond price? Bond price increase for 5 year is bit smaller, but bond price increase for 15 year is higher. So the longer maturity bond respond more, are more sensitive to the increase in the market required rate of return. Role of coupon rate. For a given change in a market required rate of return, the price of the bond will change proportionately more than the lower coupon rate. Let's suppose you have same bond, both are of 15-year maturities, 15-year maturity, but one have coupon rate, let's suppose 10%, and other have, let's suppose 12%. So this 12% bond will respond more to the changes in the required rate of return. Assume that market required rate of return on two equally risky 15-year bond is 10%. The annual coupon rate of bond H is 10% and bond L is 8%. One bond is high, 10% coupon rate, and another is 8% coupon rate. What is the rate of change in each of the bond prices if the market rate of required rate of return fall to 8? Now we will see that first it was 8% required rate of return, now it declined to 8%. What will happen to this bond prices and what will happen to this bond prices? Keep in mind that there are two bonds having same maturity, that is 15 years, having means same risk level, but have different coupon rate. What will happen when required rate of return decreases? The price of bond H is compared and L prior to the change in the market required rate of return is, let's suppose, 1000 and 848 respectively. This was the bond prices that were before the changes in the market required rate of return. The price of the H will rise from 1000 to $1,171. That is 17% increase. The bond prices of L will rises from 8 to 1000. That is 17.9% faster increase. So the bond with lower coupon rate is more sensitive to the changes in the required rate of return. Yield on preferred stock. Determine the yield of preferred stock with infinite life. We know that market value of the or the market value of the Preferred stock is dividend on preferred stock divided by required rate of return on preferred stock. Solving it for that required rate of return, so the yield on preferred stock will be calculated as dividend per dividend on preferred stock divided by market price. So this is an example. Assume that expected dividend D1 on each of the preferred stock. Sorry, it's not common stock. That is preferred stock. Each share of preferred stock is currently trading at 30 and is expected the growth rate of 15. What is the yield on the common stock? Sorry, this is not an example. Let's suppose we say that the company have currently market value, market price is on common stock is, let's suppose, 50 rupees, and dividend on the and this is, let's suppose, 10 rupees per share annually. What is KP? Solving for this, putting value here, dividend is 10 divided by price of the market price of the share is 50, so that is equal to 20%. So the yield of preferred stock is 20%, having market value of 50 rupees and giving 10%, $10 rupees per shares. Yield on common stock. Assume that the constant growth model is appropriate. Determine the yield on common stock. We know that the value is calculated as V is equal to D1 dividend in the first year, required rate of return on KE minus growth rate. Solving for KE is equal to D1 divided by P naught plus G. So assume that expected dividend means in a coming year dividend is on each of the common share is 3. So D1 is 3, that is expected value. Now expected dividend in a coming year. After each share of the common is currently, that is market value, that is P naught value. So V, that is P naught, that is D1, and that is G, what is KE. So solving for this KE, putting values here, D1 is 3, P naught is 30 plus 5%, so 15% is required rate of return of common shares. Thank you. This was all about today's lecture.